Hello again, everyone, and welcome to Index Options for Income. My name is Mark Fenton, and today I'm going to continue on bringing you some options strategy information. And if you remember last time, I showed you the diagonal, and I told you next time we would do the double diagonal, and that's what we're going to do today. Hey, and when we're done, please remember to subscribe and like the videos, and even hit the notification bell so that you can know the next time I publish a video, which I'm going to be trying to do that on a weekly basis. Well, let's get started. I'm going to share my screen, and you'll see my analyze screen here in TD Ameritrade. You'll see I already have the trade built on there. I'll go through the components. But what I do with a double diagonal, and by the way, you can put this trade on all as one trade, all four legs at once, or you can put it on as a put diagonal and a call diagonal, because it is that component. There's a put diagonal and a call diagonal. So what I like to do with this trade is I look at where we're trading. In this case, we're around 40.79, and I go down 40 points and buy a long put in a further out expiration than what I'm selling. So what I did was I went out to March 3rd. That's the one I'm selling. So I'm buying the March 6th 40.40 put. I'm going to sell the March 3rd 40.30 put, so it will expire before my long. And then over in the call side, I went out and bought a 41.20 call March 6th and sold the 41.25 March 3rd. You go, wait a minute, Mark, you're only 5 points wide on the call side and you're 10 points wide on the put side. Why is that? Well, let's take a look here. I want you to look at this. And when I move this mouse around, it tells me how much I'm up or down just for today if it moves a certain point. So if I put this on and we move down to the 4,000 area today, I'd be down about $54. But if I was 10 points wide on the call side, look what happens. I am down 3 times that, basically. So in order to keep the whole thing smooth in both directions, on the call side, I only go 5 points wide. And now you can see much smoother, because remember, we're trying to just get theta out of this. Every day the time passes, we're making positive theta in this trade. $63 today. That number increases over time. So we don't want any trouble on P&L. We just assume it moves around. You're up a little, you're down a little, and theta keeps coming our way, and then we can get out of the trade, hopefully around an 8 or 10% profit of the cost of the trade. So if I put this trade on here for roughly $1,100, I'd be looking probably to make like 125, 130 to cover my fees. So why do I like this trade? Well, I like this trade in a couple of situations. One, I do like it in a lower volatility environment. Remember, it is Long Vegas. So I prefer to put this on when the VIX was below 20. You could put it on a little above 20. It can still work as long as volatility doesn't go down against you. We've covered that in earlier videos. But it's just best practice to put it on under 20, where there's less of a chance of the VIX going down against you. Remember, VIX is mean reverting, and around 18, 17 or so has been about as low as the VIX has been over a year now. So we're just going over the recent history of the VIX to try to discern what the range is. And right now we're at 21, which is in the lower part, but we could get under 20 here. That would be an even better spot. Now, with this trade, of course, we're very sensitive to that volatility. It can make us money, it can lose us money, but this trade will be very good for us in an environment whenever we need more room. And you really do need that here at the end of 2022, and now we are in early 2023, where this trade's worked very well at the end of last year and now this year, 2023. And the reason you need so much room now is because the SPX moves around a lot as the Fed's been hiking interest rates. And every time the market thinks, hey, here's a data point, inflation or whatever, that'll maybe the Fed will slow down on interest rate hikes, then the Fed comes back and swats the market down and says, no, we're going to continue with these interest rate hikes. And those things, now I think that's happened now like 4 or 5 times in the last 2 months. So you really need that range, because the market has a great tendency lately to go up and then back down, up and then back down. And this trade will give you a lot of room, make you feel a little safer, help you be a little safer with getting your time decay and not having the trade blow out of our expiration graph. Remember, we want this trade to stay inside of where the expiration graph crosses this zero line. So roughly from 39.40 up to 41.70 area. So we do have a lot of room for this to work. So I hope you've enjoyed going over this strategy. It should be another one you could practice with on paper and put it in maybe into your arsenal someday if it's right for you. I'll be back. I'm going to try to do these on a weekly basis. I'll be back next week with another trade idea, another strategy idea, maybe even some concepts of option trading as we go along here on an option trading journey. Have a great day, folks. Bye-bye.